Are you overwhelmed by the amount of quant trading strategies and guides online? Do you feel like you don't know whether you want to make a simple or a complicated strategy, a fully automated or a semi-automated strategy, or even the derivative that you want to trade in? Then this video is for you. If you didn't know, Dr. Ernest Chan is the chief scientist of PredictNow AI, an award-winning quantitative hedge fund manager at QTS Capital Management, and the acclaimed quant finance author of 3 books and counting. He was previously a machine learning engineer and researcher at IBM and Morgan Stanley, and a proprietary trader at Credit Suisse. And according to Dr. Ernest Chan, today I am going to be listing the 4 main categories that you need to think about before you make your first quant strategy. By the end of the video, you will be able to answer all the questions that I gave above and find your perfect strategy. When Dr. Ernest Chan first started his quantitative finance career, he was in the middle of the pack in terms of automation. He would typically spend about 2 hours before the market opened downloading and testing the latest historical data, reading the company news, and send out a few baskets of orders before the market opened. And then he would typically spend about 30 minutes before the market closed to direct the program to exit various positions and close down various automated programs correctly. Quantitative finance takes up very little of your time when you refer to the operations side of the business. But if you want to grow your business and stop your current profits from declining, then you need to put in a lot of time in research and development. Since this is the creative part of the business, you can do it whenever you want. Maybe during the time the market is open, after it's closed, or even during the weekends. This is where the first criteria that you need to consider comes in when choosing a quantitative finance strategy, and that is your working hours. So if you trade part-time, you might want to consider strategies that only hold overnight and not intraday strategies. Otherwise, you will have to fully automate your strategies so that they can fully run on autopilot and only alert you when a problem occurs. When Dr. Ernest Chan started working full-time for others and trading part-time for himself, he traded a simple strategy in his personal account that required entering or adjusting limit orders on a few exchange-traded funds once a day before the market opened. But even when he first started trading independently, his level of automation was quite low. So he only considered strategies that required entering orders during the start of the day and exiting them before the close. In this case, you can even write programs that can automatically scan real-time data and transmit orders to your brokerage account throughout the trading day and when certain conditions are met. So trading can be a part-time pursuit for you, even if you earn more money from it than your day job, as long as it is quantitative. But your level of automation depends on your level of expertise in coding. And this is where the second criteria comes in. The second criteria is your programming skills. Are you good at programming? If you are proficient in C++, Java, or Visual Basic, then you can easily explore high-frequency trading strategies or even a large number of securities at the same time. Otherwise, I would just settle for strategies that are very simple and trade once or twice a day, or just a few stocks, futures, or currencies. These can often be even traded using Excel with your broker using macros. Now, of course, there's no harm in trying to learn programming skills, but if you are at the stage of your life where you do not have enough time, or you do not want to invest much time in it, then you can easily earn money from simple strategies. One of the best ways to think about this is that the simple strategies also do work, it's just that the time of the execution is extremely important. The third important thing to consider in your quant trading strategy is your trading capital. Do you have a lot of capital for trading as well as expenditure on infrastructure and application? In general, Dr. Chan does not recommend a quant account with less than $50,000. But if you are a beginner and you're just trying this out, there's no harm in trading with about $5,000 or $10,000 portfolio. Capital availability affects many choices. The first is what financial instruments you should trade in and what strategies you should apply to them. The second is whether you want to open a retail or a brokerage account. But for this video, let's just concentrate on the first one. With a low capital, you need to find strategies that can utilize the maximum leverage possible. Of course, getting a high leverage is only beneficial if your strategy is profitable. Trading futures, currencies, and options can offer you a high leverage than stocks. Capital availability will also determine whether you should focus on directional trades or dollar neutral trades. A dollar neutral portfolio or a market neutral portfolio require twice the capital or leverage of a long or short only portfolio. So even though a hedged position is less risky than an unhedged position, the returns generated are smaller and may not meet your personal requirements. Capital availability also imposes a number of indirect constraints. This includes the amount of money you spend on infrastructure, data, and software. For example, if you have a low trading capital, your brokerage will probably not offer you real-time data for too many stocks because you don't really have a strategy that requires real-time market data over a large universe of stocks. Similarly, clean historical data with high frequency costs more than daily historical data. A high frequency stock trading strategy may not be feasible with small capital expenditure. Another important thing to consider when choosing your historical data is also whether the data is free from survivorship bias. If you don't know what survivorship bias is, just consider that the data without survivorship bias is much more expensive than data with it. And if your data does have that, then your backtest will be less reliable. This is not a way to get discouraged, but just important issues to consider when you are backtesting your strategies. Dr. Ernest Chan says that he even knew a person who traded $1 million portfolio with data that did have survivorship bias, and yet his strategy was still profitable. I've given a table about how capital constraints can influence your many choices. This is not a hard and fast rule, but some issues to consider. So, summing it all up, if you have a low trading capital account, then you will want to consider derivatives with high leverage. But the derivatives with high leverage will also have a huge margin. So, you do need to find that sweet spot between those two. Then, if you do have a large trading capital, you will also need to consider the type of data and software you invest in. With a high trading capital, you open up the idea or possibility of high frequency trading. All this doesn't matter if you do not know what your goal is. And that is the fourth point that you need to consider. So, most people who want to start trading want to typically do it to earn a steady monthly or quarterly income. But if you are independently wealthy, long-term capital gain is all that matters to you. The strategy that you want to pursue for short-term income or long-term capital gain is distinguished by their holding periods. Typically, you won't be generating a lot of monthly income if you have a year-long strategy. But if your strategy holds stock only for a month on average, then your month-to-month profit fluctuation is likely to be fairly large. The upshot here is that the more regularly you want to realize profits and generate income, the shorter your holding period should be. There is a misconception aired by a lot of financial advisors saying that if your goal is to earn maximum long term capital, then the best strategy is the buy and hold one. This notion has already been proved to be mathematically false. In reality, the maximum long term growth is achieved by finding a strategy with the maximum Sharpe ratio, provided that you have access to a sufficiently high leverage. Therefore, comparing a short term strategy with a very short holding period, small annual return, but very high Sharpe ratio, to a long term strategy with a long holding period, high annual returns, but lower Sharpe ratio, it is still preferable to choose the short term strategy even if your goal is long-term growth. If you're here to learn about quantitative finance, then you're typically not looking for long-term stock holding positions. Therefore, when choosing a quant strategy, you need to keep in mind how long the holding period is and how high the Sharpe ratio is. The Sharpe ratio is probably one of the most important things to consider when you are backtesting your strategy, and even more important than your returns. To sum up all the points that you need to consider before you make your quant strategy is your working hours. So if you are working part time, then you will want to consider strategies that require little intervention. But you can have intraday strategy with fully automated ones if you have good programming skills. Good programming skills translate to more complicated strategies. But the strategies that you choose also depend on the derivative that you invest in. So the derivative also determines your capital availability. The more capital you have, the more options you have in trading derivatives. If you have a low capital, then you will need to find a sweet spot between low margins and high leverage strategies. And the last thing you want to consider is your goal. So if you want short-term growth or long-term gain. If you found this video useful, definitely leave a like and subscribe. It will really help my channel out a lot. Check out my other video on the Yahoo Finance Guide, where I go over everything you need to know when you want to deal with downloading financial data. And let me know what video you want to see next in the comments below.